Hello and welcome to my channel. My name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. I've been an inheritance tax specialist for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning and the implementation of that planning. So today's video is a very useful topic on the different types of trust that you would utilize to place assets into to take them out of your estate for inheritance tax. What are the different types of trusts and how are they used is the question on the table for today's video. So welcome back, and today's video is around the different types of trusts that you would place assets into. So I get there's life insurance trust where if you die a life insurance policy pays into a trust. That's not what we're talking about today. We're talking about assets that you place into a trust and what are the different types available. So first of all, there is an outright discretionary gift trust where you're just going to give the assets away. You've got loan trusts. You've got discounted gift trusts, and probably one that you've not heard of, which is flexible reversionary trusts, and how all of those types work and how they interact with each other. So first of all, let's say you've got some assets and you're more than happy to give those assets away. Let's say you were going to give your children a couple of £100,000 as a deposit for a property or something like that, and you had no expectation of that money coming back to you. Why would you put it into a discretionary trust as opposed to just giving them the money? Well, if you put it into a discretionary trust, that trust can then lend the money to your children, and if they are unfortunate enough to get divorced, that loan could be recalled back to the trust, thus protecting the assets in the long term. So you could watch my video on why estate planning is more important than inheritance tax planning, and that outline some of the other issues around gifting into trust. Okay, so that's one mechanism where you didn't want anything back at all. So you may also consider putting a property into a trust. Now, generally speaking, we don't do that often because most of the time landlords want the income from the rented property. Okay, so if you want the income, you can't put it into a trust, because if you put it into a trust, you can't get the income back because you've effectively given it away, and it would fail for inheritance tax purposes because you'd be getting the income back again. So it's not a viable option. If you're happy to give a property away and not get the income at all, then yeah, it is an option. However, there are, generally speaking, other mechanisms which are maybe more effective than that. So what's the other choices? So you can get discounted gift trusts. Now, I'll be honest with you, we haven't done a discounted gift trust for years because we believe flexible reversionary trusts are considerably better. But a discounted gift trust allows you to place an investment up to $325,000 into the trust. Well, in fact, in a discounted gift trust, you can actually give more because of the discounted rate. Technical, we won't go there, but let's say you put 300,000 into a discounted gift trust. Right. At the outset, you have to determine what income stream you want from that discounted gift trust. So right from the word go. We always used to call these fixed income plans because it's a plan of money placed in a bond which is subject to a discounted gift trust, and the income stream comes every single month back to you, or every single year back to you, whether you need it or not. So in our experience, some of these that we set up 20 years ago, the clients are in their 80s now and actually don't need the money, but we can't switch it off. Once it starts, it can't be turned off, and that's the problem. It's very, very inflexible, but it does allow you to get money outside of your estate. But for people who know they have an income stream need, and that income stream is anything under 4.5%, you are actually allowed 5%, but because of charges and things like that, because of charges you go over the 5% withdrawal, there would then be an annual tax charge on that. So for most people, 4.5% is probably the limit that they should extract. So you can see it does have a benefit for people who need a steady stream of income and are prepared to do that. Okay, but it's fixed and cannot be changed, and therein lies the inflexibility, which is why I don't like them. Okay, you can get loan trusts. So now we do use these quite often. So we tend to use them in alliance with flexible reversionary trusts. So let's say you've put your full allowance of 325,000 per person into a flexible reversionary trust. I'll explain how that works in a second. But then you've got more money, right? And you're thinking, right, well, in another 7 years, the two of us, as a married couple, will put another 650,000 into these trusts in 7 years' time. And we think we're absolutely going to live 14 years. We're in our early 60s, very little chance of both of us dying. And therefore, we think that's a reasonable risk to do it. So you put your 650,000 potentially into your flexible reversionary trust, and the other money could go into a loan trust. So what you're doing there is you're making a gift of £10 to the trust, which settles the trust, and then you're making an unlimited loan to the trust. So if you've got several million, but you don't want to give it to your children now, and you drop it into a loan trust, the money, all the growth is outside of your estate from day one. So it stops the inheritance tax getting any worse, but the loan to the trust is still inside of your estate for inheritance tax purposes. So you see, it's a stopgap mechanism. It's not a long-term mechanism. Okay, so then flexible reversionary trust. So basically there, and why we prefer them to discounted gift trust, is that you take the plan, you put in up to 650,000 for a married couple, or 325,000 for an individual, into that trust, and you can get your capital plus the growth back every year. And generally we set it up so it's 1/7 of the capital, 14.28% per year. Every year we ask, do you want the money back? And if you want your 14.28% plus the growth back, you get it. The growth on the money that you get back is taxable on income tax, but the capital is free of tax. Now, you don't have to take the money. So if you don't take the money, it drops on the end of the 7-year stream of income, for want of a better expression. And if you don't want it in year 2, it drops in, and it then becomes year 9, in year 3 becomes year 10, etc., etc. So every year you've got an entitlement to 14.28% of the original capital that you invested plus growth out. So you can see a married couple doing that would be effectively be able to withdraw £96,000 in any given year. And that's just the capital. Let's ignore the growth. So it's an extremely good plan, because if you set it up in your 60s and let's say it doubles in value, so by the time you're in your 80s it's worth £1.5 million or whatever, you've got £1.5 million that you can get back if you ever need long-term care. So it gives you big peace of mind knowing that it's a possibility. If you want to know more about that particular plan, there is a video called One Trust to Suit Everyone, and if you watch that we go into a lot more detail on how that particular trust works. But flexible reversionary trust I think are much better than discounted gift trust for that reason. But if you marry up a flexible reversionary trust with a loan trust with a view that after 7 years you take the original capital that you put into the loan trust, take it back, and then put it into another series of flexible reversionary trusts 7 years and 1 day later, you can see that's some quite sensible planning. So the 4 different types of trusts, as I say, that are generally used in this basis are gift trusts. You give the money away, can't get anything back. Loan trusts, the growth is outside of the estate, so it's good for parking up money for a while and just stopping the problem getting any worse. Discounted gift trusts, fine for people who want a relatively low level of steady income every year and are never going to change their minds. But better still, flexible reversionary trusts, you get the money out when you need it, up to 14.28% of the original capital in any given year plus the growth. We think that's much more flexible. So those are the different types of trusts that are generally used for inheritance tax. Yeah, you do get other, trusts like disabled persons trusts and things like that. We do set up trusts for grandchildren as well. Those are generally whether you give money away on your death, not during lifetime. If you want to give money away during lifetime, there's a different type of plan for that particular environment, and that makes more sense. Okay, so those are the different types of trust, and thanks for listening. If you found that video useful, then please give us a thumbs up. But thanks and bye for now. Bye.